Welcome back, everyone. Today on the Joseph Carlson Show, we get into yet another busy week in the stock market. Last week felt like a year. It felt like a long time period to invest throughout all of this chaos, uncertainty, all these constant changes in policy regarding tariffs. We've seen the effects that it's had on the 10-year treasury, commentary from different businesses, and the impact, the whipsaw of the stock market. Well, now we get all of that. It's continuing on. And we're entering into earnings season. This is where these companies give their report card of what happened over the past 90 days, as well as they, more importantly, give commentary on their views and perspectives of the current environment and what they're expecting over the next 90 days or the next year. This is where we get to see what companies are saying. And this week is very busy. If we look at the Qualtrim earnings calendar, this shows you day by day dynamically which companies are reporting earnings and information about their earnings. And here we have on Monday, Goldman Sachs that has already reported earnings. Now I circled some other really important companies. For example, on Wednesday, this Wednesday, we have ASML. This is one of my key investments, one of my newer ones. I made a significant bet in ASML. TSM is also reporting earnings on Thursday. And we're going to see both of them this week. Their commentary on what to expect with iPhone demand, with chip processing and AI demand, everything related to all these high-end companies. These companies, in many ways, represent the demand that all these big tech companies are facing. So this is an incredibly important week with these two very crucial companies reporting. And then on Thursday, we also have another one thrown in. After market close, we have Netflix. Netflix is one of my most significant investments. It's a company that I've talked about for years. It's the reason that the Story Fund is doing so well, and we get to see how they're doing and what they expect for the future. So we're going to dive into the numbers, what the expectations are, and I'm going to make some predictions overall with this earnings season of what all these companies are going to say. I believe there's going to be some common themes, especially regarding the tariffs and uncertainty. So I'll be going over just a few predictions about this earnings season. Now, of course, we also have some news to get to. We have an interview here. This one is Ray Dalio. He went on to Meet the Press. And I like this because this is more of a territory that's outside of the investment circle. It's not CNBC or Fox News. Now we're getting to just everyday people. Everyday people that don't even work with finances. They're not addicted to looking at the stock market, just normal people. And then you have Ray Dalio there, who's like the most bearish of all the bears, sitting there just blasting them with all this incredibly frightening information. Ray Dalio, I've criticized many times as being a mega bear, a continual bear. He's persistently negative and concerned and worrying about one thing or the next. Well, this made it to prime time, and this interview went hyper viral, getting multiple millions of views just on YouTube. So we're going to be looking over some of the key arguments he makes. I'll be responding to some of the things he says that are incredibly bearish on this environment. Now, to balance out Ray Dalio and his gloomy outlook, we also have to look at what Tom Lee is doing. He is much more on the bullish side, always looking for opportunities, optimistically, and he's very constructive about what's going on. So we're going to get the viewpoint of both someone that's overall bearish and someone that's bullish. And then finally, one of the most amazing stories I've read is that this AI shopping app that this guy made promised that if you buy something from the app, it was the artificial intelligence going in and buying it from these random websites. So you could just click on something you want to buy. You didn't have to do anything else. The AI would figure it out. But in reality, it was all powered by people in the Philippines. This is one of the most crazy stories that I've heard of, and it's just the state we're in. This story is emblematic and representative of the current state we're in. So we have a ton to get into in this episode. It's going to be an interesting one. Now, before we jump in, just one thing I have to mention. You'll notice that I'm not sponsored by different companies. I'm not constantly plugging VPN services or Audible or whatever it may be. I don't have any of them as sponsorships, and that's an intentional choice. I could if I wanted to, but instead I focused on building a product that I think you'll actually enjoy. Something that I think offers real value to investors. That is Qualtrim. Qualtrim is $10 per month. And the reason that I can charge such a low price for it is I own it outright. There's no other partners. The team that works on it with me is incredibly efficient. Qualtrim costs a third or a fourth as much as other stock analysis tools, and in most cases does way more than them. You have the insights page that gives you all the fundamentals of a company in visual format going back 30 years. You have KPIs, which are key performance indicators of companies, like Netflix subscribers and revenue by regions. You have the discounted cash flow calculator that's incredibly simple to use, earnings call transcript summaries, you have the earnings calendar, and so on and so forth. It comes with a ton of functionality, and it's getting more powerful every single day. I have my developer working on this all the time. So if you want to try it out, I think you'll love it. If you join today, you won't pay anything until the beginning of next month. And if for some reason, if you say, hey, Joe, I tried it out and I accidentally got charged for some reason, we get free refunds. No questions asked. We only want people that love it. And there's a lot of people that do. We have over 9,000 members on it, and it continues to grow. So try that out if you haven't. Now let's go ahead and jump into this week. We have, starting off Monday, a company that's already reported earnings, which is Goldman Sachs. For long-term investors, we like a market that's generally not that volatile, one that just goes up over time. But for day traders, for short-term technical traders, they love a volatile market. A surge in trading activity fueled by investor uncertainty about President Trump's policies is minting money for Goldman Sachs and other big banks. The Wall Street firm joined JP Morgan and Morgan Stanley in reporting a bigger profit for the first quarter, fueled by record revenue in its equities trading and lending unit. Banks have been raking in fees as investors reposition their portfolios in anticipation of how Trump's trades and other economic policies might rattle markets. But in terms of anticipating the future, the commentary of the CEO is one of the ones of many business leaders saying that they believe we're going into a recession. Quote, the prospects of a recession have increased, with growing indications that economic activity is slowing down around the world. So Goldman Sachs is yet one more voice to raise the red flag of a recession. With the Goldman Sachs CEO saying that there's a higher percentage chance of a recession, I believe this is a good point to jump into some predictions I have overall about this earnings season. This is broadly speaking across the board for every company. I believe there's going to be a lot of talk about consumers slowing down. We saw a little bit of evidence of this early in the year with Texas Roadhouse. They noted that last year things were incredibly good, there was strong growth, but going into this year, they saw in the past just couple of weeks, customers slow down. Same-store sales were flat, they weren't growing. That was the first red flag of a consumer-led recession. But that was before the tariffs were introduced. With the tariffs being introduced, the level of uncertainty has gone up. In fact, we have some surveys here just over the past couple of weeks showing that consumer sentiment fell 11% in April. It's down 30% since December of 2024. Now, if consumer sentiment is falling and customers don't want to spend money as much as they did, that's going to show up in the revenue of companies, in their bottom line. So we're going to hear a lot of companies reflect that. A lot of CEOs say that consumers are being more cautious. They're trading down a little bit. They're wanting to spend a little bit less money. They're wanting to see more deals. We're going to see a lot of commentary about that with every company that works with consumers, which is almost all of them. Then we also have this theme playing out right now, and I believe something that's changed over just the past couple of weeks since all of this tariff policy has come into play, which is that business leaders, CEOs, and investors alike have become aware that a small group of people, just a few people in the United States, can rapidly implement policy that dramatically changes the potential earnings of companies and their entire landscape. These changes are dramatic, monumental changes to business prospects, led by someone that can do it at a whim, without any regard to Congress, and someone that has the wherewithal to do it and face the consequences. That is a change in risk assessment. Whether you're pro-tariff or anti-tariff, this new realization that only a few people can do this so rapidly and to such a great magnitude is a new uncertainty in the market that investors will price in. The market is already uncertain. Stocks are already unpredictable to some degree, but this new adaptation that investors have become aware of has raised the unpredictability to a whole new level. Now CEOs are unsure of how much money they're going to earn over the next 3 months, of how well their business is going to do. Because not only do they have to project their future growth based on their business performance, but they have to guess about policy of which they can't possibly know that can change day to day. So I believe there's going to be a lot of commentary about CEOs and CFOs saying, we just don't know. We have no clue what the tariff rate will be, but we can give some vague predictions based on what it may be. I think there's going to be a lot of guessing games, a lot of just kind of, maybe it's this, and in that case, the business might do this. Maybe the tariffs are lower and it's business as usual. But either way, I think CEOs and business leaders are going to be negative on the tariffs. They're going to mention how the cost of them are passed on to the consumer. They're going to mention how it's going to slow growth. They're going to mention how it's going to raise the chances of a recession more than they were before the tariffs. I think we'll have a repeated theme of CEOs relaying that information to investors, just like the CEO of Goldman Sachs did. Now, let's go ahead and take a look at some of these companies individually and break down my expectations for these earnings reports. First of all, this week we have ASML. ASML is a stock that I have in the passive income portfolio, so it's in my main one here, and it's one of the newer positions. Currently, the stock is in the red by 8%. That's $3,000 on a $42,000 position. Now, a stock going into the red soon after you buy it is really not a problem. In fact, if you read Peter Lynch's books, he talks about how his best investments happened 3 years after buying the stock. That's usually when he saw the best returns from his companies, was 3 years after. I've owned ASML for well less than a year, so this one really hasn't had a lot of time to grow, and I'm still very optimistic about this company. Now, if we go to the earnings calendar, ASML reports Wednesday before market open. We can go to Qualtrim here and look at the what to watch for. This gives you a summary of the biggest points to look for each company. With ASML in particular, this company beat on their expectations big time in Q4. So last quarter, they had a monstrous quarter. It was actually incredible. We see that ASML far surpassed their expectations with $9.3 billion of sales last quarter. We're going to be looking to see if they continue momentum, or if they say things are going to slow down dramatically. The other thing that I'm most interested to see in terms of ASML is not only their commentary on what the demand outlook looks like for the different chips and high-end things like car chips and phone chips and whatnot, but I also want to see what they say in terms of geopolitical factors, their business in China, how they view the tariffs. I want to see what they say about all of that coming into play. I think they'll have overall optimistic outlook. Investors are going to try to dissect ASML and see whether or not they can see the demand outlook for artificial intelligence with companies like Nvidia, companies like Google, companies like Meta and Amazon with ASML's report. So this company's report will act like the first weather vane of what direction the AI demand looks like for all these other companies. The other incredibly important company reporting this week is TSM. A lot of people have asked why I invest in ASML instead of TSM. And simply put, ASML has even fewer competitors than TSM does. And TSM is a highly concentrated, monopolistic business. So that gives you an idea of how monopolistic ASML is. But either way, their commentary and what investors are going to try to look at is very similar for both of these companies. They're going to look at what the demand outlook is for all of these devices. Things like Teslas and EVs, chips for smartphones and televisions, you name it. All of that comes through TSM. Based on their most recent earnings report, TSM noted that their AI accelerator revenue showed impressive growth and that they expect it to double in 2025. So they've already noted that this form of revenue is going to double, and investors are going to see if that's still the plan, if that's still their projection, whether or not that estimate's moving upwards or down or staying the same. Overall, both ASML and TSM are going to be companies that investors look at as the weather vane for big tech and other big companies. These are going to be the first ones giving us an indication of what to expect. Now, moving on later throughout this week, we get to Thursday after market close, and we have Netflix. Now, let's take a look at my position in Netflix. This company is one of the larger positions. I've held it in the Story Fund for years. I've really liked this company for a long period of time, and I bought more of it during the dip, which really bolstered the performance of this portfolio. It's made up for the majority of the gains, with $51,000 in the green. Even Amazon or Google or Microsoft pale in comparison of buying Netflix during the dip. So of course, Netflix turned out to be a great deal buying it in 2022 when it was almost $200 per share. The question is, what does it look like now? If we look at what to expect from this company, we can take a look at some of the key things to look for with Netflix. Netflix is executing on a lot of things at the same time. For example, one of them is their advertising tier. I want to see how many users or members they have on their advertising tier. Then we have their content spending forecast. Netflix has said that they've increased their budget a lot, and they're increasing it to $18 billion from $16 billion. So they've increased the budget by $2 billion. That's money they could have generated in free cash flow, but they're now producing more and more content. We also have big currency impacts on this company and their hedging strategy. Netflix makes over 50% of their revenue outside of the US, so currency has a big implication on their earnings. And we have the market penetration and price strategy. Netflix has frequently announced price increases on their membership during their quarterly reports. So they'll report earnings, then they'll announce a price increase. They've done that over and over again. I don't know if they'll announce a price increase this time because they've recently done so, but Netflix is a company with substantial pricing power, and they've leveraged this over the past couple of years. Not only have they increased their budget dramatically, but they've increased the price of their service as their service's value has grown. When I look at Netflix today, and my assumption going into this earnings report, I still love the company. I still love the stock where it is today. It's a little bit more than where I'd want to buy it if I was first entering into a big position. I'd try to buy it for around $730, a couple $100 lower than it is today. But even at today's price, I think that it will beat the market. And the reason why is simple. When investors look at valuations, they make the same mistakes over and over again. They look at the multiples of a company without looking at the growth. And I see this same thing over and over again. People say it's crazy that Netflix trades at a 36 forward multiple. But whenever you look at the multiple of a company, you have to match that with the expected growth of the company. For example, yes, it's true that Netflix trades at a 36 multiple. But if we go down and look at the earnings growth of the company, it also adds in some context. Over the trailing 12 months, Netflix has grown their earnings per share by 65%. So 65% growth is incredibly fast. That's 3 to 4 times the average of a fast-growing company. That's 10 times faster than the S&P 500. So obviously when a company is growing earnings 10 times faster than the S&P 500, the multiple deserves to be a little higher. Netflix's earnings per share has skyrocketed over the past couple of years. So this 35 forward PE ratio could look very expensive if the company grew by 6 or 7% earnings over the next 5 years. But my expectations for Netflix is that it's going to grow more in line of 25% earnings per share growth over the next 5 years. If it does that, it'll still justify its valuation. Even with the uncertainty in today's market, I believe these companies will do well. I think ASML is going to have great earnings. I think that the company's undervalued. The same thing for TSM and Netflix. Netflix hasn't gone down as much because the company's not quite as affected by tariffs, but I also believe they're going to have very strong earnings. So my expectation going into this week is even with the overshadowing of uncertainty, the earnings reports are going to be good. Now moving on, we get to some news that I won't call shocking news. In fact, this is probably the most predictable news that you could ever dream of. And that is that Ray Dalio is making media rounds predicting calamity and future economic distress. Now, saying that Ray Dalio is going to predict future calamity and problems and warn about things is like saying that the ocean is wet or that the sun will rise from the east tomorrow. It's a prediction that you can make with a relative level of confidence. And here we have again Ray Dalio doing the media tours talking about what may happen in the future. And this one had millions of views because it had a very catchy tag that Ray Dalio predicts something worse than a recession.
Talking about a recession, do you think it is likely that the United States will dip into a recession because of President Trump's tariffs?
I think that right now we are at a decision-making point and very close to a recession. And I'm worried about something worse than a recession if this isn't handled well. A recession is 2 negative quarters of GDP, and whether it goes slightly there, we always have those things. We have something that's much more profound. We have a breaking down of the monetary order. We are going to change the monetary order because we cannot spend the amounts of money, so we have that problem. And when we talk about the dollar and we talk about tariffs, we have that. We are having profound changes in our domestic order, how ruling is existing, and we're having profound changes in the world order. Such times are very much like the 1930s. I've studied history, and this repeats over and over again. So if you take tariffs, if you take debt, if you take the rising power challenging the existing power, if you take those factors and look at the factors, those changes in the orders, the systems, are very, very disruptive. How that's handled could produce something that is much worse than a recession.
So here he uses a lot of words like changing order, monetary, and managing changing order. It's a lot of euphemisms or abstractions of what he's really saying. When I listen to this, I think he's talking about changes to the US reserve currency status, changes to how businesses are managed, and the debt, how the debt is being handled.
The budget deficit can be reduced to 3% of GDP. It will be about 7% if things are not changed. If it could be reduced to about 3% of GDP, and these trade deficits and so on are managed in the right way, this could all be managed very well. I believe that members of Congress should take the pledge, what I call the 3% pledge, that in one way or another, that they will get that budget deficit down to that number. If they don't, we're going to have a supply-demand problem for debt at the same time as we have these other problems. And the results of that will be worse than a normal recession.
He's saying this lightly. What he's talking about is the U.S. literally going bankrupt, where the interest rate on the U.S. debt becomes so expensive that even if we raise taxes, even if we try to tackle it, we can't pay for it. And the fact that we can't pay for it means that taking out future debt becomes even more expensive because investors don't want to buy the US debt because the credibility goes down. This is a vicious circle. This is what the government dramatically needs to avoid. And in this concern, I share it wholly with Ray Dalio. I think that the US needs to get the budget under control. I think they need to get it down to 3% of GDP. He talks about how Congress should make a pledge to do this, but Congress has the opposite incentive of controlling the debt. Congress's incentive for themselves, which everybody looks out for number one, right? Congress's number one incentive for themselves is to get reelected. The way that they get reelected is by promising lots of goodies for their constituents. That you're going to get your thing you want here, that we're going to pass a budget that gets the thing you want here, that everybody gets the stuff they want. Nobody wants to pay on debt. That's not something that every constituent is calling in and saying, hey, did we pay down the debt today? That's not a popular item, but that's exactly what we need to be focused on. When would Congress ever agree to a rule like that? It goes against their first incentive, which is to protect themselves. Ray Dalio here realizes he's on an everyday show with normal people watching this. So again, he uses a lot of light terms and euphemisms, and he tries to lightly explain that owning someone else's debt is only an asset if they have the ability to pay it back.
The value of money. What is a storehold of wealth? That is a bond. In other words, one man's debt is another man's assets, bondholders. And so we're going to be in a situation where if that storehold of wealth is in jeopardy because there's too much supply and demand and so on, and we have a monetary inflation, we will have great disruptions. And that could be like the breakdown of the monetary system in 71. It could be like 2008. It's going to be very severe. I think it could be more severe than those. Imagine if we have a downturn politically and an international conflict.
Very grim potential outlook from Ray Dalio. Ray Dalio gives these warnings that always get a lot of attention and a lot of media, just like any other predictions of calamity. And one of the things that these hosts always do, like this one does here, is she mentions that this is the guy that accurately predicted the 2007 financial crisis. And while it's true that Ray Dalio predicted that, they don't mention that he also predicted 20 different crises before and after that didn't happen. Overall, his accuracy in predicting economic calamity is incredibly poor. He almost always is wrong. He rarely ever gets it right. He's the definition of the clock that's broken that's right twice a day. If a clock is broken and says it's 6:30, that clock is going to be wrong almost all the time until it's 6:30, and then it will be right for 1 minute. And that is Ray Dalio. He's almost always wrong with his predictions. You can look over his entire history, and when he finally has something bad happen in the economy, that's when he's finally right. But overall, these predictions are highly theoretical. There's a lot that the US can do to avoid these type of calamities. And talking about them this way, I think overall is very good to sell books, very good to get clicks, very good to make it seem like you can see the future and you have a bigger thought process on this. But in most cases, it's entirely unhelpful to investors. In most cases, the market goes up. In most cases, it's good to stay invested all the time. If we look at an investor that's the opposite of Ray Dalio, someone that is optimistic, advocates staying in the market, advocates looking at things through the lens of repair and recovery, that is Tom Lee. The reason that Tom Lee is more reliable than Ray Dalio is because statistically, being in the market all the time is the more accurate and better choice than being concerned about stocks all the time, staying out of the market and trying to predict when there's a market crash coming. So Tom Lee, statistically, by his bullish stance, by always being optimistic, will be far more correct than Ray Dalio. He's kind of the inverse of the broken clock. Tom Lee will be correct almost all the time, except for a few. So here Tom Lee is once again talking constructively about how he thinks now is a good time to buy.
I do think markets are getting a little desensitized.
That's what I mean, yeah.
Yeah, and I think part of it is if someone had an investor hat on, not tactical hat, you know, really good opportunities are emerging because the number of stocks below the 200-day moving average was like 15%. Historically, that's a strong buy signal. I mean, you're going to find a lot of bargains there, and the VIX got above 50, and it almost always pays you to buy the stocks when VIX is above 50. But in the near term, it's a roller coaster. I mean, it does feel like we're having a lot of zigs and zags, and even over the weekend. But to me, I think everything that happened over the weekend, including the Sunday further explanations, all of this is still unequivocally positive for stocks.
Tom Lee is still undeterred from owning stocks. He also comments very specifically on this whole idea that people are abandoning the US, that people don't want to do business with the US.
I think that is the narrative at the moment, that, you know, US exceptionalism's over and people are selling treasuries and dollars to buy other assets. But I'm not in that camp that it's sustainable, because unless weaker dollar and higher yields suddenly makes the best companies in the world outside the US, you know, the best and the most important companies in the world are American companies. They've produced the best shareholder returns. And, you know, if you look at the S&P, 40% of the returns of the S&P come from new companies every 10 years. Is there going to be suddenly the best new company coming out of Europe instead of the US because of the dollar? And I doubt it. And I think US companies are going to adapt.
Tom Lee's logic behind still staying in the US with your investments makes perfect sense to me. I agree with it 100%. That right now in the world, the US has the best companies. That's almost not even a point to argue. Look at all the best companies that give the best shareholder returns. They're in the United States. And even in the future, you can look at where risk capital is, where there's investor appetite, where there's people starting new businesses, entrepreneurs, all these different software companies and AI companies. Most of that is happening still in the United States. Another way of looking at this is Tom Lee's basically arguing that the United States, if it was like a business, it's got a very good economic moat. It's a very good quality business, and it can endure even if leadership is doing some crazy things. Even if they're just shooting from the hip from time to time, the business will endure. So I agree, and my money's going to stay where I believe we have the best companies in the world, and most of those are in the United States. Now, finally, we get to a news story here that's just incredible. Here's just the title of it. The AI shopping app found to be actually powered by Philippines call center workers. Now, that understates what's going on. A fintech founder in the US has been charged with fraud after it was found that his artificial intelligence shopping app relied heavily on the Philippines call center employees to complete the purchases manually. So the app was reportedly marketed as a universal shopping cart app that simplified online shopping by AI by enabling its users to skip the checkout on retail websites by reducing purchases to a single tap. For example, if someone wanted to buy a pair of sneakers, for instance, they could just buy the sneakers by opening the Nate app and clicking buy. The app claimed it would take care of the remainder of the checkout using AI, such as, quote, selecting the appropriate size, entering billing information and shipping information, and confirming the purchase. So that was the whole premise of this app, is that you basically have an app, you go in and you just click on an item, click buy. You don't have to go through any of the sizing or checkout options. Artificial intelligence would do that for you. In truth, Nate relied heavily on teams of human workers, primarily located overseas, to manually process transactions in secret, mimicking what users believed was being done by automation. Hundreds of contractors, or quote, purchasing assistants in the Philippines and call centers were working to manually complete the purchases occurring over the Nate app, the investigation found. Now, the Department of Justice tried to estimate how much of the actual purchases were completed by artificial intelligence and not humans, and they said it was around 0%. I would love to just ask this founder, what was the plan here? When did he realize this was all going to cave in? He couldn't have fully expected it to work out. To promise to people it was all driven by artificial intelligence while secretly having the Philippines complete the purchases. At some point, he had to know he was way in over his head and the ruse was up. The jig was up. This isn't going to work forever. I'd love to know when that was. So hopefully we get some type of documentary, something small that explains this in greater detail, because I'd love to get the bigger story behind it. But that's going to be it for this episode. Hope you enjoyed. See you in the next one.